They say two things in life are unavoidable: death and taxes. And in investing, it's not about how much you make, but rather how much you keep. Today, I'll be breaking down the 4 different tax classifications of investment income and show you why understanding them can save you thousands in the long run. Alright, so let's jump straight in. I wanted to go over this new little article I found about the 4 different tax classifications, and they provide examples and visuals so that it's easier to digest. So, how are investments in non-registered accounts taxed? And for this article, there's going to be 4 examples, and each example is going to be on $1,000 of investment income and a hypothetical 40% marginal tax rate. So the first type of income is interest income. This is where it's 100% taxable. And so if you earn $1,000, then you will need to pay $400 in taxes. And a common example of this is GICs, which are guaranteed investment certificates. Nothing special to say over here. So next type is dividend income. This is slightly better than interest income, and this because the government kind of encourages dividends, and so they give us a few different tax credits, and so you end up paying like maybe 20% less in taxes. So over here, the example is you only need to pay $200 in taxes. And this is just like regular dividend income from your investments like Coca-Cola, Visa, and whatnot. Not too special. So now, the third one is return of capital, which is ROC. This might be less heard of, and it's actually very controversial and misunderstood. So it's basically deferring your taxes, and so if you earn $1,000 of ROC income, you don't need to pay any taxes on it right now. But basically this ROC would reduce this return of capital would reduce your adjusted cost basis of your investment. So like lowering your book cost. And then so when you pay taxes when you sell, so that's why I said it's deferred. So when you pay tax when you sell, you need to pay capital gains, which is basically tax on the appreciation of your asset. But capital gains are pretty efficient. We'll go over in the next one, but basically you only need to pay half of the income, like only half of the income is taxed, and so it's pretty efficient there. This is very misunderstood, so let me know if you guys want another video on it, but I'll just move on for now, but I'll come back. I want to show you guys something. So the last one is capital gains. And as I alluded to before, you only need to pay half of the income you receive as tax bills. So if you made $1,000, then only $500 is taxed at 40%, which is $200. So you get to pocket $800, and then you have to pay $200 in tax. So going back to return of capital, I want to show you guys how you can actually determine if your distributions from your covered call ETF is ROC or capital gains, or what is it? So if we look at, for example, USCL, which is a pretty common ETF, if we scroll down to the financial reports, if we look at, I don't know, let's say 2024 annual report, right? And then we search for return of capital, right? Or basically the chart would be like something to do with its distributions. And then I would say how much of the distributions are ROC and how much are from capital gains. So I'll basically break it down. So as you can see, in 2024, they paid out $2.53 for each share. And out of this 253, 114 was ROC and 139 was capital gains. So you need to pay some capital gains here. But if you look at 2023, all of the 138 that was paid out was ROC. And so there was no tax that you needed to pay for that year. All right. Yeah, so again, just open the financial reports and then search for distribution breakdown or return of capital or something along those lines, and you should find it. So I also wanted to go over how ROC income is created. So essentially, it's when you're using your year's losses to offset your year's gains. If you're familiar with capital gains, you know that you can offset your future gains by realizing capital losses. So there's a great article from Harvest about generating tax efficient cash flows using covered calls. And if you scroll to the near bottom or the middle, it says there are several situations where an unrealized loss becomes a realized loss in the ETF. And while this has no impact to the NAV of the ETF, which is the net asset value, there may be ability to carry forward that tax loss. And then this can be utilized against the option premium earned or the income earned, and that can change the tax treatment despite the cash flow being generated pay the distribution. So what it's saying at the end is basically these losses can use to offset your gains. So it's similar to tax loss harvesting if you are familiar with that. But basically it's just within the same year. And the fund managers at Harvest or wherever you're investing do it for you, and so they're smarter than me or you, and they're just handling the money and making it as tax efficient as possible. So that's actually another reason why I love covered call ETFs, because they're so tax efficient. And it even says in their products, like for example, if I look at HHIS, where is that? Oh, high income shares. If we look, it says the advantages are that it's Canadian trusted and it's tax efficient. Here is a visual that I found that compares all 4 tax classifications in one picture, and you can clearly see that capital gains and ROC are the most tax efficient classifications here. Oh, I also forgot to mention that for return on capital, you remember that your adjusted cost basis, your book cost, is lowered with every ROC payment, right? And so once it reaches zero, it can go negative, of course. And so then the income would be just capital gains, which is the next best option. So that's not that bad. And in terms of tracking your adjusted cost basis, you can do it manually if you want, but it might get confusing. And so all stockbrokers would do this for you. They usually do it like once a year in maybe April or something after taxes are done and reported. Yeah. I also wanted to mention that you can always follow my live portfolio to see what I hold on Blossom. So follow me there if you want to check it out. So remember, income investing is not just about how big the distributions are, it's about how much you get to keep in your pocket after taxes. Once you understand this, you'll be way ahead of most investors. If you enjoyed this video, give this video a like and comment down below what tax classification surprised you the most. Don't forget to subscribe for weekly videos. See you in the next video.